Okay, welcome to another episode of Real Deal Investing. I'm here today with my co-host Larry Mastropieri. Hi, Larry. Good morning.
How are you? Good morning. What's up, guys?
We got another great guest today. We got Quentin Wendt from PadSplit. Quentin, we've been chatting with, and I've been getting to know PadSplit, the company that he works for here over the last few months. We have some clients of ours that are starting to use their services and talk very highly about those services and the money they're making, utilizing the PadSplit sort of a method to share and rent rooms within a property. And we want him to come today and kind of explain how that works and how you can get some incredible returns from using that method. So Quentin, welcome. Great to have you.
Thanks so much. Thanks, John. Larry, good to meet you guys in person. This is interesting because whenever I go to live conferences and everything else, I have to go like this to see if I can actually recognize the person that I've seen on Zoom for the last couple months.
So well, hopefully we can meet a person soon. Yeah, and you can use your phone. Yeah, there you go.
This is fun. Thanks for having us.
Yeah, by the way, I love the Pac-Man game. I'm going to spend half the time staring at the
awesome.
Yeah, I grew up playing that game in the arcades, so it shows my age. Yeah.
This is like the last bastion of things that I could beat my kids in. So I refuse to move on from it, you know?
That's funny. That's funny. That's good. That's good. Well, cool. Well, again, great to have you. So why don't you tell us a little bit about first about you, your journey in real estate and how you got to PadSplit, and then give us sort of a high level overview of PadSplit after that.
Sure. I am the general manager for PadSplit. I focus primarily on operations, but I've expanded into working with hosts for more on the sales side as well. Is the fun part about it is I am really young in real estate. I joke that I'm like 2 years old in real estate. I've historically been a serial entrepreneur. Going way back, I started working for a consulting company called Accenture, or when I started, it was called Anderson Consulting. Moved on and then ended up owning my own business. It was a distribution company that I sold in 19, and COVID hit, and I have too much ADD, OCD, all the DDs to sit back and do nothing. And I had the fortunate opportunity to meet the founders at PadSplit, and it was really interesting because they're on this hockey stick curve of growth. And, you know, just put it in perspective, when I joined 2.5 years ago, we had 3,200 doors. We just crossed our 15,000 door plateau, which is amazing in 2.5 years. So something is right.
Yeah.
You know, like our strategy, as you're talking about our exit strategy, we have so many tailwinds that are helping our investors find us. And then it's up to us to try to help them become really good operators in terms of how do you follow the strategy in converting a property from a single family 4-bedroom into a co-living 7 or 8 bedroom, and then the business behind that. And I think that's a key point, is that it's not just getting to the finish line of converting properties into our asset class, but then it's operating the functional business on the backside. And that's where your revenue is made. You know, like I think most people in real estate understand this is a long game. So none of these assets that they're buying it's not day trading. You know, we are tied into 5, 7, 10-year horizons for people to maximize the revenue in this asset class. And I think that's the beauty of it, is that as we're so young and so many different types of quote unquote avatars come to us, whether you are a short-term renter, a long-term, you know, holder, or even a midterm investor that owns properties, our asset class generates more revenue than most. So the last 2 years, it's been a wild ride as I talk in pictures, but I'm essentially unplugging from whatever revenue stream you were doing before. And then you're plugging into our revenue model, and those operators that get it, they understand it's a hospitality business and they understand it's an operational business. They're killing in terms of revenue. So
I want to understand a little bit more about exactly what the business model is and what these investors are doing and how you're helping them.
Sure. So the easiest visual is if you pop onto that slide, we'll just jump right in.
See if I can do that.
Yep.
There we go.
So our investors essentially are buy and holders for single family rentals. And what they've done is they use all their own existing experiences and knowledge and just know-how in terms of acquisition. That really stays the same. So if I'm an investor and I can acquire a property correctly, because we all know that all your money is essentially made on the acquisition, and we're no different. So investors will buy a single family rental in the right area in the appropriate neighborhoods, understanding the end business, meaning that you're not going to buy in an HOA. You're not going to buy across the street from a Karen who's going to complain about cars parked out front. You're not going to, you find an asset that checks off all the boxes, and it's not just limited to what's in the house, because our business will affect things in the neighborhood. So if it's a high rental area, if it's something that your neighbors are not going to complain about the number of parked cars out front, because you're essentially housing 6, 7, 8 people. That's kind of our sweet spot in a single family neighborhood. So investors will buy a single family residence, and we are essentially monetizing underutilized space. So we will convert spaces such as dens, dining rooms, in living rooms, and we'll put up temporary walls. And the commodity in which our platform, because PadSplit is a two-sided marketplace digital platform, we are the nation's largest digital platform in terms of single room occupancy, that we rent out individual bedrooms to members. We call them our tenants, that you guys would think about it. And they rent a safe, affordable, all utilities, all furniture included bedroom, and they share common space. So it's very European. It's something that makes a lot of sense for folks that lived in high density areas like Metro New York, Manhattan, or somewhere in San Francisco, or even if you were a military background, you understand shared space and co-living. So what's happening is we literally crammed into this wonderful niche where the workforce of America that makes $80,000 or less, they have a really hard time finding affordable housing close to where they live. So our platform has grown over the last 5 years, pretty much across 20 cities in the US, primarily large metros, but we're expanding into some areas where individual investors are bringing us in. So the methodology is pretty straightforward. You buy a single family house, 4-bedroom, 3-bath, 3-bedroom, 2-bath, and then you're putting up temporary walls and making bedrooms out of those. You post them on our platform, and you market them on our platform on the supply side. So that's very much like Airbnb. It's pictures, listings, descriptions, and then we move on into renting them individually by the room. So the individual investor that started out with a long-term rental at $1,800 is now essentially renting out 6, 7, 8 bedrooms at $600 to $800, $900 a month. And that's where the gross revenue changes. And that's where our model changes, is that the individual investor has an asset that is just driving 2 to 3 times top line gross revenue for the same initial asset that they bought as a long-term rental.
Okay. No, that's
Got
great.
it. Now, there's obviously CapEx involved in getting these properties where they need to go.
Mhm.
You're still seeing the yield on cost be pretty interesting.
Very much so. Very much so. And we actually, if the direction could be given for best way to do what we do, it would be following the model of a fix and flipper, which means that you're going to buy a distressed property with the long-term idea that your exit is predicated on your after renovated value. And then in there, because we essentially, the thing that we can take advantage of is because we're a single family rental, we're taking advantage of the financing that's out there. So we get 30-year fixed. So unlike a commercial property, instead of having a 5-year balloon, you're getting the 30-year note on something that and it's put into your net operating expense as a line item, so they can work around that. The beauty for us is that if you buy something distressed and then you were going to put a CapEx in it for the renovation, you can reallocate those same CapEx dollars into our exit. So we don't need to chase down granite countertops. We don't need to chase down, shaker cabinets, because, somebody's going to want that as a comparable to the neighborhood. We reallocate those dollars accordingly to putting in finished walls at renter grade finishings with LVP flooring. And then all of a sudden, those same dollars that you were going to use in order to get to your appraisal that you needed, it's reallocated appropriately so that when you go to refinance into 30-year debt, those numbers make sense because you're going to take, 75% of that appraisal number, recoup the dollars that you had invested into the property. And now you're really talking about cash on cash returns, which are hyperinflated in our world if done correctly.
Interesting. Are you doing this in South Florida right now?
We are doing it all over Florida. Florida is our second largest market as a whole. We are essentially a Sunbelt company right now. That is where we started. We're 5 years started, based out of Atlanta. And then our first expansion went into Florida. Second expansion went into Texas. And now if you look at the map across the country, we're essentially along the entire Sunbelt. So it's like a big happy smile starting in Philadelphia, Baltimore, going down the East Coast, across the Southeast, and then popping back up in Phoenix. So we have investors that have found our strategy and they've either owned existing portfolios and said, wait a minute, I'm getting $300 a pop as a long-term rental. What would this look like if I converted it? So those investors who have portfolios, they're having a grand old time because they're converting something that was making $300 to net $1,200 a month, $1,000 a month. And their CapEx is minimal because they're just putting in the walls at that point and furnishing. So their returns are significantly higher. My favorite is starting from scratch, is that if you can be a really good investor, acquire properties that are distressed, put in your renovations and you're exiting, you're refinancing that product so that you have minimal dollars left. And if you utilize all the tools and guidance that we give, you can essentially burr still. And I don't know too many people that are burring, at 6, 7, 8% interest rates, but in our model, they are. And I think that's the beautiful unlock for sophisticated investors. And that's a wonderful little, pot of gold at the end for new investors, is that wait a minute, I'm not leaving $100,000 in this rental property that's going to take me, X amount of years to get back. I'm getting my money back in a year, and now it's an infinite return. Let's go redeploy those dollars and actually build a portfolio of these things.
Yeah, that's pretty interesting.
Can you, for those who are kind of new to this model, and including me, can you explain the difference between the differences between this model and, let's say, an Airbnb model?
Sure.
What does it look like? Yeah.
So it's primarily around how revenue is collected, and then the operating backside. So in Airbnb, they will typically be successful if you're a B plus A neighborhood, because Airbnb is, if you look at it in today's lens, it's essentially an arms race. So if you're looking at the listings that are doing well, it's location driven. So if you're near a lake, near a mountain, near a national park, and you have your lazy river, or you have your, sauna, or if you have your cold plunge pool, you can compete at this level, right? So the Cold War has happened. The problem that surfaces for Airbnb investors that were late to the game, so 2020, 21, 22, those investors are sitting on assets where their occupancy went from what they predicted at 70, 75% to make a lot of money. They're down to 44, 45, 50% occupancy. So because they rent the way they do, they essentially they monetize time. So in your house, you would get 3-day weekend bookings, and there's 4 of those in a month, right? But in our world, it's much more of a midterm strategy where our average stay is 9 months across the country. And it's primarily because of who we target as our demographic. If you have the want business of an Airbnb, like I want to go on vacation, versus the need business, which is what we are essentially working in. If I'm an employee making $80,000 or less, where am I finding safe, affordable housing, all utilities included, fully furnished for $800, $900 a month? And that delta really exists for folks that are in large metros, whether it be Orlando, Tampa, South Florida, even Jacksonville. I can find a delta between average market rate rent at $1,500 to $1,800 versus what I'm paying here at $800, $900. That delta is big enough where the residents or members in our world are like, oh, that's worth it. So they'll stay, come into a shared community. It's co-living and shared housing, whether it be new for them the dollars, essentially the juice is worth the squeeze for them to come into our community and then find that the value that they get is so high that for $600-800 of savings a month, they can do something with that.
Got it. Makes sense. And yeah, it's definitely, this model has its own niche for sure. Question. So I know some properties that some of our investors that we work with, Larry works with, or I work with, this might work really well for, especially those that maybe invest in single family homes, that they can do these conversions, hopefully permitted, sometimes unpermitted. Not that matters to you probably, but
it does. We want them to permit the work.
Sure. That's always a best practice. So with that being said, what about for multifamily? Is there any profit model in this for them? So let's say a lot of our clients have 2-bedroom, 1 bath, or 3-bedroom, 2 baths. There's not a lot of converting that you can do for a variety of reasons, probably just not enough space in an apartment, or maybe if you are trying to do this permitted, code isn't going to allow you to chop up walls in such a small area in an apartment. So is there any model for PadSplit in those types of units?
Very, very much so. And I think that's the beauty of being a digital platform. Like, entrepreneurs are finding a way to leverage our platform to benefit their business. And the interesting change in the multifamily model for a lot of people is that they were struggling with occupancy. So in the multifamily worlds, if you're looking at, especially B class, B minus multifamilies, they may be running 60% occupancy, which is a huge problem because of the way that their valuation is set up. So if it's a cap rate and you're driven by occupancy and revenue, one of the strategies that a lot of multifamily that are finding our space, what they're doing is they'll designate one building as co-living. So your 2 1s, your 3 2s, now all of a sudden you're renting by the room. And essentially all you did was put a lock on the individual door and the front door. And they're removing a third of their assets, and they utilize our platform for occupancy and revenue. And then what happens is it boosts their occupancy across the other 2 buildings that they may have that they're renting traditionally. So they're using a hybrid approach where they're saying, hey, I can go ahead and generate revenue at an inflated rate in building 1 if I use co-living. It's essentially what large LIHTC projects have, right? I'm going to designate 10% of housing for affordable housing. Well, they're retrofitting that using our model for existing buildings. And that's essentially the value that multifamilies are utilizing our platform for.
So I don't know how well you know our South Florida market just off the top of your head because you work in so many metro markets, but let's say the average 2-1 here in South Florida gets you about $1,800 in gross rent. Typically tenant pays the utilities. Could you give some type of just off the cuff estimated model for what type of revenue if we turned over a unit to you to do, or a client of ours did to the PadSplit model? What would that look like? How much would each room be rented? How much would the gross revenue be, et cetera?
For single or multi?
Multi-family, 2-bedroom, 1-bath apartments. Let's say you had a triplex, 3 2-1s. You decided I just want to do one of these 2-1s on PadSplit because the other 2, I think I want to keep long-term tenants. But let me test this out. Let me try one of my 2-1 units. What does that look like?
Got it. So I'll give you the comparison. For multifamily, our juice is made in adding revenue streams into the actual asset. So that's why 4 bedrooms converting to 6 or 7, that makes a lot of sense. Okay. For multifamily, it's more about stop the bleed more than anything else, because it's hard for me to add in 2-3 bedrooms to maximize the revenue model in a multifamily. Sure. But what it does is it allows you to stabilize occupancy and revenue collection for multifamilies.
Got it.
Because you're not going to be able to add in twice as many bedrooms into a multifamily. But what you end up doing is you open the aperture and lens for people that are renting in that physical asset. So for a 2-1, 2-2, or 3-2, instead of it being $1,500-1,800 of regular rent that is 60% occupied, now it's $1,000 for each bedroom. So if you have 3 bedrooms, now you're generating gross top line of $3,000 for the same asset. And your occupancy is about 85 to 90% filled. So it's limited in terms of like top line revenue for multifamily. And that's why the model makes a lot more sense on the single family side, because you're essentially doubling the number of bedrooms, which is the commodity we trade in, to generate more revenue. So it's a tool for multifamily. You're not going to see the same yields that you would in a single family acquired correctly, but it's just a different way of getting revenue, the way that you're trying to capture more steady revenue and reduce your occupancy rates.
Yeah, I could definitely see this becoming more important if we are truly moving towards a little more towards a recessionary economy. We're seeing some signs of that. I mean, there's some, I don't want to go down that rabbit hole of whether we are or not. But one thing that Larry and I, who we both own multifamily, can attest to is that we are seeing a bit of softening, not just in the rents, but also in how long it takes to find tenants. So if that, sort of vacancy rate starts to creep up a bit, this might be the perfect opportunity for something like that, where, again, let's say you owned a triplex. You may say, I'm having a hard time renting, these properties out. Yeah, I have 2 tenants in here, but maybe I'm going to use PadSplit for one of those units. And because I'm sure there is a much higher demand for room rental, especially when the economy is taking a hit. People just can't afford it. So
I agree. I think that demographic of I need safe, affordable housing, less than $1,200 a month, that demo is only going to grow. Yes. We know that, right? And the thing that's really interesting is because when we saw interest rates rise at 8% and rents follow accordingly, you saw a natural compression. So the buyers of SFRs at 300 to 250 to 300 compressed down, and now they're renting, 3.2s for their family at 2,500, right? Because they could qualify. And then it just compressed everybody down one level or one strata. And I don't think that's going to change, and this is just, what we're witnessing, I guess, across the board. That's why. Yeah. And I think that's going to be like that for, the foreseeable future. That's where the traditional method for PadSplit, buying an SFR or single family rental, converting it to a PadSplit model, you're essentially making a multifamily from a revenue stream perspective out of a single family asset. And you can leverage all the benefits of a single family asset, but you're unlocking multiple streams of revenue in a PadSplit model in a house where it's 6, 7 bedrooms. So let's say it's an 8-bedroom house, but you only have 6 bedrooms filled. There's never zero occupancy in this house. And I think these are like the little hidden gems of what our platform is that somebody in room 7 and room 8 may move out, but rooms 1 through 5 are still paying their rent. So you don't have zero revenue months.
So we've interacted, and Jerron, I'm sure you've been involved in this too, with, owners that rent by per room, right? Whether it's multifamily, large multifamilies, and or just single family homes. I sold a home to someone that Jerron and I both know. They had 8. They built it out. They had 8 rooms basically set up in there, and they were doing it themselves, right? They weren't using a PadSplit model. They were just doing this. And my recommendation to the buyer was like, hey man, like you're collecting 8 G's a month on a, I don't know, a $550,000 purchase price. Like that's an awesome return. Especially when I think at that moment we were borrowing at like 4.5, 5.5, somewhere in that space. Like this is amazing. So and he made the decision he regrets this to this day. He was like, no, I'm going to get in trouble, whatever. I just want a clean, simple execution. I'm going to change it all back. So he changed it all back. And now he's just like, oh my God, what did I do? So, because I told him from the beginning, I'm like, you're buying an investment property. There's 8 people in this thing. It's working well. Take the manager that's currently managing it. Just let him do his thing. If it blows up, okay, then go ahead and, move it back to what you want it to be. But so anyway, I guess my commentary on that is, they do this. They were doing this, or these investors we've interacted with in the past, they do this without PadSplit. What is the difference from an operational side of things?
Scalability.
Okay.
That's essentially the biggest thing. So our platform is digital, and we essentially provide 3 primary values to you, the end investor. the first and most important is we fill rooms. Because we're a two-sided marketplace, like the short-term rental people would know this term. We're an OTA. So an online travel agent essentially is we book the rooms. Because we're a two-sided marketplace, we spend, $1 million a month on no, maybe not. It's like $50,000 per market that we're in. It's pretty close. So essentially, we're spending $500,000 a month aggregating members and letting members know, hey, we exist as a marketplace. So if you Google search, hey, rent by the room in Tampa, we're going to be the first SEO search that's out there. And then we aggregate across all these other listing platforms, whether it's Zumper or Roomies or, even Zillow, where people are looking for rent by the room or, shared housing. We're the first place they go to and find. So we literally aggregate the demand or the revenue side. And then we allow on the supply side, Jerron, the investor, his property is listed on our platform. And those rules are no different than Airbnb. And that's the thing that I just have to stress to anybody that's watching. Your pictures matter, right? So it's like, I joke that it's the Tinderification of rental. If your picture looks like this, but I get there and it looks like this, that person doesn't want to live there. But if you're staged properly, it looks really well, because that's the number one thing people see is location, and then they go right to the pictures. If you, to your person's point, I spent $500,000 on this asset, and then I refuse to pay $250 for professional photos. I'm like, why are you doing that? The folks that come from a hospitality, short-term rental background, when they come to our platform, they are slaying. They're killing it because they understand the mechanism in which people are renting rooms, and they're thriving. Non-sophisticated investors that just kind of said, hey, the P&L said that I'm going to make this much money, I'm going to cut costs as much as I can to get there. They're the ones complaining about occupancy and room fills, because they don't realize it's a competitive marketplace where the person next to you, same price point, but everything visually looks amazing. And that's what the members are booking. So the three pillars, we fill your rooms. We fill them really quickly. 7 days for the first booking, 21 days to get to 80% occupancy. By 60 days, you're essentially 100% filled. And the churn in room 5, room 6, or whatever, maybe because somebody moves into a pad split. They're like, whoa, I'm sharing a bathroom with 2 other people. That's not what I thought I was going to get into. So that person may opt to move out at the end of 30 days. But then we fill the room again in 7 days, and then we continue on with the revenue model. Secondary big thing that we do is we do all the collections. So to become a member on our PadSplit platform, you go through a background check, you go through an income verification. So everybody has the same essential background qualifications. That person pays their rent digitally. We collect all the revenue digitally. We pay out to the individual investors. And then the third major thing is that because we're a digital platform, everybody's got either an app or they've got the desktop model where communication is key. So we understand that there's 8 moving parts in a house. Somebody's got to listen to what's going on. We triage all of the member tickets for maintenance, for member-to-member issues, or hey, this house has a leaky toilet. That's really important. We communicate with third-party property managers. So Larry, you would hire Jerron's PM company to manage your asset. And to your friend that you had 8 bedrooms, if he wants to scale, he doesn't want to listen to 8 people complaining about noise or complaining about somebody stole my peanut butter. That's what the third-party property managers who understand co-living, that's where they thrive, is that it is the operating business that sits inside the 4 walls. And that's where the long-term revenue is made, is because they treat it like a hospitality business. They're responsive. Their response time is really fast. And then the member who's in there feels valued, so they continue to stay.
Talk to me about the management piece. So obviously the communication, I own some Airbnbs. So it's like the Airbnb thing model, right? Mm-hmm. They communicate through there. You respond very quickly. And so everything's kind of done within the platform. Money's collected within the platform. Communications done within the platform. And so the person that's managing it, do you guys offer management services, or is that the owner's responsibility to figure out the management piece?
Part of our mission to scale, we had to create our own property management firm. And then over the last 2 years, we spun that out. It's a sister company. It's called 2 Keys. And all they've ever done is manage co-living properties. As we've expanded into every single market, Larry, you come to me with a portfolio and you're a sophisticated investor, you have your own team. I've got my acquisition team. I've got my property management team. I have a GC team. If you want to continue to work with those folks, by all means. But we'll go ahead and work with your property managers to train them on the nuances of being in a co-living space. If they want to take that on and create a separate hybrid division that does this, we go through and train them on this is how to utilize our platform. This is how you get the most communication and value out of it. And they are the ones that actually physically manage the property. Because we're a digital platform like Airbnb, we will triage anything coming inbound and then communicate to the actual operator. And then it's on the operator to handle a clogged toilet or somebody, the AC is not working. Or in the case of what we're just dealing with now, I have a hole in my roof because a hurricane just went through, right? So like we have the ability to triage problems really quickly. And then that's where the value of your third-party property manager really makes hay, is that how responsive are they? And then how do they treat the members in the house? And that member is like, hey, I feel valued, so they continue to stay even through any issues that they have.
So you guys are still, so can the operator just communicate directly, or is there still going to be someone inserted in between that?
No. You always have direct communication. But what essentially happens is if, Larry, you're a member in room 2 and something comes up, you will submit a ticket, and that automatically gets a triage response from our customer service team. They're 24/7 on the member side. And then it's forwarded to the property managers on their dashboard, and then the clock starts ticking. One of the things that was really valuable for us was not all PMs are created equal. I think, anybody who's an investor understands that. And then, unfortunately, the observation is that there's diminishing returns on size. You show me a property manager that can scale like this and then increase their customer service, and I want a unicorn, I want to marry that person. But in reality, the ones that get it, they triage tickets really quickly and then they respond. And I think that's the one thing that is so beautiful is like people just want to be heard. I know that it's going to take 3 days for an HVAC person to come in July in South Florida. That's just the nature of it. But for God's sake, respond to me and let me know that the person's coming on Tuesday. And then we'll suffer through. The great PMs will drop off fans or something to mitigate some of the uncomfortableness. But those are the ones that do really, really well on our platform, is that they treat the members the way that they would want to be treated.
Got it. Okay, cool. So that's pretty neat. So it is almost like an Airbnb model where you have your own Airbnb manager handling things. You're seeing the communication in the system. They can respond quickly. Even if there's a ticket, they can respond to that quickly as well. That's cool.
Absolutely. And I think that the Airbnb, I like talking to Airbnb hosts. So Larry, you and I would like this because at the end of the day, you're the only group that looks at my model as less work. Right. So it's the operational side of it. Two big values for Airbnb hosts is that if you are facing legislative change, Phoenix is a perfect example of this. Dallas is going through the same thing, right? There's fear that they're going to get rid of all Airbnbs. Atlanta is also suffering from the same thing. Those investors that are low risk tolerance, they'll convert their properties to a pad split because of the way our rental agreements go. It's minimum 30 days on the front side. And then it's week over week renewals. So
I was going to ask that next.
Yeah. So we get over the barriers that are short-term rental restrictions. So those investors where their properties make sense in the right neighborhood, they will convert. And it's a really simple conversion for them because they have all the furniture, they have all the photographs, they know how to do these things. The two values that I give you are, instead of one house trying to get rented and you have to go through third parties like Guestly or Hospitable or somebody else to try to fill your room, we handle the room fill and the revenue, collection or aggregation for that. Meaning that like we will find members to fill your room really quickly. The second part is your operating costs go down significantly because on a normal Airbnb, it's $250 to clean a house. In our model, it's significantly less because we're only cleaning common spaces on a minimum monthly, suggested bi-monthly, for kitchens and living areas if there's a common space area and bathrooms. If
Got it. So you have a cleaning person come through twice a month is the
absolutely.
recommended best practice for the manager to have that happening. Okay. That's interesting.
And there's a nuanced reason why, which people don't understand till they get there. So 7 rooms in a house, you have 1 room left, and you clean your house once a month. So it's on the 1st of the month that you clean that room. If the person doesn't move in until the 21st of the month, their number one complaint is, oh, the house is dirty. We're like, wait a minute. No, it's not. Like it's cleaned on a monthly basis. And that's why I suggest twice a month for larger houses, is because your first initial impression, your bedroom might be pristine, but they're walking through common space areas. They're like, oh, the kitchen's got a whole bunch of dishes and the bathroom's a mess. The house is quote unquote dirty. And then everything past that is I'm looking for reasons to complain. So the best operators, they have to do some education for members coming inbound. We educate new members coming inbound. They get it. The craziest stat is if I come in as a member. So Jerron gave me a referral. Hey, we have a room opening up in the same house. It's really close to where we both work. Come on and move in. The member gets a referral fee. The house gets filled quicker, and that person knows what they're walking into. That person will stay 3 times as long, unless it was Larry that came in off of a Google search and he's like, what the hell's going on? Why are there so many people here? Blah, 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 blah. So that discrepancy is huge, and we're working on just better educating and setting expectations for all members. But essentially, if you know what you're getting into, and it's not an Airbnb, right? It's not a weekly motel. Those people thrive because their expectations are here. The reality is here. That space is so, that space for resentment is so much less that they just thrive in our marketplace and in the rooms that they rent. So that's essentially a huge thing for us, is that organic referrals are the bread and butter for our growth, is because people know what they're getting into.
I have a question. How do you kind of deal with and address the issue of tenants who maybe are messy or being a little problematic? Maybe they're playing loud music. I'm sure you get those complaints all the time. Yep. Do you have like a rating system for the tenants, kind of like Airbnb has, so that you can say, hey, listen, this is the second or third complaint. The landlord may terminate your membership here at this property. Number 1, they have the option to do so, not renew you. And number 2, they could give you a really bad review, and then you're going to have a hard time finding another place or clean up your act. What are those sort of methods that you have besides the education? You said educating them on expectations. Yeah.
That's the number one thing in anything that is shared, right? Is that I'll always tell investors the number one thing I want you to realize is there's no magic solution for dealing with poor human behavior. Mm-hmm. And the best ways and the best operators that we have that do well in this space is they screen really well. Mm-hmm. So even though we do a background check and a economic, can you afford the actual room that you're renting, it doesn't speak into what kind of human you are. So the best operators will have a secondary screening. Well, they'll just ask, simple questions like, have you ever lived in co-living before? What are your expectations? How long do you want to be here? Are you aware of our cleaning cycle is every, twice a month? And they just set the expectation inbound where that person, they understand what the house rules are and then they're actually that conversation of you're part of a community. It starts early. And most people that we've found is if you tell them what the guidelines are, here's the bumper bowling, right? Stay within these lanes. And then they reiterate the value of what you're paying. This is the trade-off. Those hosts that do a really good job of setting the expectation early, they have a significantly larger and longer tenure, which is where in our model, money is made. You make money on long, consistent tenure. And then because, this is fun, because we're a marketplace. So Larry, you're not really only going to buy one of these. You end up buying 3, 4, 5 of these. And we have hosts that are finding unique ways to maximize. So their first house would be 8 bedrooms. All right, let's identify the people that like co-living. Well, I don't want to live with 8 people. Okay, I have another house in my portfolio that's 5. It's in a better area. I pay a little bit more. This person will get transferred or offered to transfer into the 5 bedroom. So I go from off of 275 near the casino, and then I go into Westlake, or I go into a different area where it's like, hey, it's a little bit better. The opportunities are better, but I still want to save $600 to $800 a month in rent. I will transfer to a different house, but I stay in a co-living because that's my only vehicle where I can reduce my housing costs. And that's when it gets really fun, is when the member side realizes how to use our platform for their own betterment, and empowerment for making choices. That's kind of the best case scenario. And new, which is fun for us, is God forbid that person actually realizes there's a program called the Dreamer program, where if you stay for 10 months, save $800 a month, that's your down payment for your first house, right? And there's programs that are federally funded for, empowering people to become first-time home buyers. And then because of the background that they stayed in for the last 8 months, guess what they're doing? They're house hacking, and they're creating generational wealth from their own experience. And that's the beauty. And in our world, we would always ask, hey, you want to list that back on PadSplit and then continue generating revenue that way? That's kind of a North Star for us, is the member utilizes our platform for their own financial empowerment. And then the cycle just continues from there.
So I have a question, and this is directed both at Quentin and Jerron. Jerron being the eviction expert slash one of the biggest eviction attorneys in the state. Like, how does this play out in that situation where someone won't leave, or you're having major issues with people? Like, how do the rules apply, at least for the state of Florida? Jerron, Quentin. Yeah.
Let me start into this, Jerron, and I'm going to pass you the baton.
Sure.
So poor member behavior, rules violations, essentially are within our platform. Your expectation are 1, 2, 3, and 4, right? These are the house rules. If you violate those rules, we don't like overnight guests. We don't like dogs. We don't like pets. We don't like smoking inside the house. All of these things, right? Or even worst case scenario, you stop paying. Our first action is addressing the person directly. Hey, you're violating the rules. Correct your behavior. Secondary piece of that is you continue to violate rules, we're going to give you a notice to vacate. And every state has their own requirements for 3 days, 10 days, 14 days for notice to vacate. If they fail to go down that path, then we initiate the eviction process. Unlike, we're not immune from evictions. So the path is, if we have to move you toward eviction, then we'll contact Jerron and his firm and say, hey, somebody in room 4 is getting a notice to vacate, and then we're moving down the eviction path. Their membership is terminated, and then we go down the path of a standard eviction, because that is legally the only way we can have somebody physically removed from a room. Those are the laws of the state. So we have to follow those same laws in every state and jurisdiction we're in. We go down the same path of magistrate, but I'll kick it over to Jerron about what he does at that point.
Sure. Yeah. No, thanks, Quentin. Everything you said is correct here in Florida. We have had just a handful of situations with PadSplit members that needed our support in getting tenants out. The good news is it's not been an overwhelming number, so it shows that you're doing something right here. So that's great. Yes, essentially it would be up to what the PadSplit agreement says. This would be a tenancy because they are paying money, even if you're calling them a member. You're using different names for it. So typically, if they're not paying rent, that would be a 3-day notice here in Florida. If they just need their tenancy terminated, if they're on that week-to-week basis, then we would be giving them a 7-day notice of termination of week-to-week tenancy. There could be a variety of different avenues and ways to go about doing this and enforcing it. But in the end, you're correct. If they don't just voluntarily leave, then we would need to initiate the eviction procedure after that notice, whichever notice we gave expires. And that's typically somewhere between normally about 4 and 6, maybe 7 weeks, depending on where that is in Florida. But, again, fortunately, I don't think this is such a common scenario. So, and what I've learned both with, shorter term rentals or medium term rentals, such as what you all are, or the long-term rentals, like you said, background checks up front, very important, not just traditional background checks, but even sometimes having those conversations or getting those questions answered. And if you feel something's not right, you move on to the next candidate. That's my my opinion generally on these types of things. So I do have another question for you though, Quentin.
Yeah.
What about the exit strategy? I know you're a relatively new company, so you probably haven't had a ton of people building portfolios up and then selling onesies, twosies, properties or portfolios. But the only, I don't know, I guess speed bump I could see here on an exit strategy would be if you're taking and converting a traditional, let's say 4-bedroom, 2-bath property into a 7-bedroom, 2-bath property, and your bedrooms are getting real small. Maybe when you're trying to exit, you're going to have a little more of a challenge in selling that property onto a traditional homeowner. So maybe you're really wanting to transition that off into another short, medium term landlord, or someone else who's on the PadSplit sort of team. So
Yep. No, that makes a lot of sense, because it's very similar to, these are the objections that new hosts that are not in our ocean, they ask these questions, which is amen, right? If I can answer all of the massive blockers for you and overcome these objections, then afterwards you're coming into our world eyes wide open. Never in the world did we say we don't have evictions. We're just real estate. We don't have a magic bullet for that, right? Humans are humans. The nuance difference in our model would be something similar to, like, 5 bedrooms are still paying. Your 1 bedroom is under eviction, so you don't have a zero net sum for the month. So, like, we have nuanced benefits of what we do, but your question was around exit strategies.
Yeah.
We have about 2,000 investors that raise their hand and they say, hey, I'm really interested in co-living. What I don't have is 2,000 people that own a house ready to convert. So the benefit to that is that we have our own marketplace online where Jerron, the investor, is like, you know what? This is a pain in the ass for me. It's more work than I thought I was going to do. I thought I was going to be a mom and pop self-manager. I'm going to dispo this and go back to doing whatever it is that I did before. They can sell it on the marketplace, like you said, right? And that's probably the fastest way they're going to dispo that house, is because I have so many investors that want to buy it because it's already existing cash flow. And, like most businesses, I'm better than that guy, watch, and they come in and they'll buy it and they're like, I'm a better operator. And they come in and they buy it. Essentially, you, the investor, are selling it at a cap rate now. Instead of it being, I'm chasing market rate appraisals, you have running cash flow for a year. So you're selling it at a cap rate. So that's how people are getting premiums. The people who understand that simple concept are the flippers. So the flippers that are really good at distressed acquisition, renovation to a set purpose, they're like, wait a minute, I can continue doing what I'm doing and then sell these fully converted as a cash flowing asset to people who are looking for new properties. That's real. That's happening right now. And that's the fastest way to dispo a property. The other way is you list it on the marketplace, Zillow or whatever the case may be. You can deconstruct a handful of the walls. And then, set it out and sell it as a regular single family. But again, in that world, it's 2 different demographics that you're trying to sell to, right? The same mom and pop's like, hey, where's the living room? Hey, where's the den? But you can reconvert it back to that pretty reasonably. It's like, $1,000 or $1,500 to take down some walls. And then you go from there. But for the most part, we don't have properties that completely delist off our platform, because the easiest, simplest way is to transition it to another buyer coming inbound.
Plug and play. Yep.
Mm-hmm. Mm-hmm.
Yep. Good.
And so you have a marketplace where you can essentially sell your assets as well.
Yeah, and it's a third-party marketplace. We stay out of it. All we do is provide data. And I think that's one of the biggest things that people don't understand, is that because we're the nation's largest co-living platform, nobody has more co-living data than we do.
Yeah.
Meaning, like, where, how much, how do I underwrite, what's a suggestion for me to go acquire? And we provide that freely, because until we get to 1 million doors, all we want to do is grow. And the transparency and the visibility is, I don't want you to be a pissed off host that says, hey, you told me $400 a week. No, this is the real data. This is what's historically been collected. Look on our site, look at the pictures, look who you're competing against, and leverage it, right? It's our AirDNA data, essentially, that we provide.
Let me ask you this. So, as an Airbnb host and someone who
Mhm.
helps buyers or investors buy Airbnbs, we've gone down this rabbit hole every which way. How do you really know what an Airbnb is getting exactly? Like, right? Like, what are they actually making on them? Because Airbnb, AirDNA, they're not really showing you exact comps of the nightly stay, right? They're telling you what, unless somebody's got some data that I'm not aware of out there, you can correct me if I'm wrong, but you're just seeing what the active asking price was when it went under contract, if you will,
Yeah.
for lack of a better word. So like you're kind of guessing at to a degree at what you think your nightly number will be. Airbnb gives you some predictions. AirDNA tries to give you predictions or projections. And I've never felt super comfy with that, especially as a guy coming from the multifamily space where I'm buying multifamilies. I can go look at exactly what people rented for. I can call apartment
CoStar.
buildings.
Yeah.
I can understand all these things and really get the numbers and really know the answer versus the Airbnb thing. It's a little different. How does your platform work? Is it similar that way, or can I see what these guys are actually renting for? Or what?
We are pretty transparent. Once the host is selling and they give their approval, right? We will be very transparent about the data for occupancy and revenue collected. The number one thing that we cannot sustain for growth is you bought it here expecting, but you're delivering here, because our growth comes from Larry deciding this model works. 30 days, I got the revenue I expected, and then he goes to continue building his portfolio. It's the fastest way we grow. Our numbers for 22, 23 and into 24 are, if you buy a house correctly at the end of a 12-month run, you have 3 of these. Because imagine Airbnb 2011, 2015-ish or so, right? Early adopters of that exit strategy were early adopters, period. And then what they ended up doing was like, oh my God, this thing actually returns the numbers that I thought. Let's go replicate it. And that's our model. Essentially is that our hosts on average will own 3 to 5 of these at the end of 2 years. So that we don't have to go get a million new hosts, right? We're building a asset class that people want to play in. So to your point is, we give you as much raw and true accurate data as possible on that property. And then we give you all sorts of comparisons as to, hey, in this geographical area, this is the range. This is what people have historically booked, not what people have listed at. I've got people listing at 300 with hopium, and then we have to go beat them down to like, yo, this is really what the market is actually setting. But the caveat to that, and I'll throw it in there, is that like, we're more like Uber in that way, is that you're starting to see stratification for the assets that they're putting on. So it could have been historically 155s in a certain area, but then all of a sudden somebody comes in with a better product. It's primarily my Airbnb guys. Like, I think I can demand 225. Arizona and Phoenix were a perfect example, is that we told them historically across the country, average room rate's 155. These guys were like, hold my beer. And their listing average price is like 225 because their asset is better.
Yeah.
So the demo that they're attracting are young professionals, working professionals who just didn't want cheapest, fastest. They wanted something quality and they're willing to pay for it. And that's where the stratification is really starting to delineate itself. And that's the marketplace model for us, which makes it really exciting.
What if I'm a guy who's picking up something, I have the skill set to renovate, so I'm not buying something that's already in place, and I'm trying to understand what the room rate will be per night, per week, per month, whatever, for each room. And I'm looking at the data on your platform to say, hey, there's a guy up the street, he's renting it. Do I see the comps? Do I see what he's renting for? Or
absolutely, yeah.
Okay,
So
I know what he's renting for per night, and I know he's fully occupied or not, like all that stuff.
So the number one vehicle that people don't use for data is create a member account. It's free. And go search in the area that you think you want to put a bid on a house and start looking at the pictures and the comp by location. And you'll start seeing the range of room prices. And then when you click on it, because you want to see more a picture that interests you, it'll say, 2 rooms available out of 7. So you can extract out what occupancy is in that area. But if you are really serious, you're working with one of our account executives at that point, and they give you all the backend database data around like, hey, this is the true occupancy. And then they give you even more incredible data, which is days to occupancy.
Great.
So it's not just check off the box, it's filled. That thing took 41 days to fill at that price. But the neighbor at 177, he filled in 7. So your underwriting starts at what's my comp around me? How do I underwrite it for however many bedrooms that I want? And what is the finish that I need to get to? And that's just utilize what's available for data from the member side, because that'll dictate a ton on your acquisition and how to finish.
Got it. So there's support from an account executive. And
yeah.
So explain that. How does that work?
So in the beginning, it depends on how early you want to engage them. My suggestion would be the earlier, the better, because the more data that you have, we spend a ton of time talking about the physical box of the house. And then our AEs are getting significantly better talking about the business that you're running after this thing goes live, because those decisions will nuance a lot of your buying discussion. It could be the perfect house, but now all of a sudden there's no parking because it's on a double yellow line road or whatever the case may be. So they will help you say no to more properties. God willing, God, please say no to more properties, because more deals will come, right? So you say yes to the right property because it has parking. It's not on a septic. It's not around, and it's not in an HOA. It's not around neighbors that are going to complain. It's not in a neighborhood that's already, very far down the path of gentrification. You're just in a right location. And then from there, now you hone in on what should the price be? How should I set up the room? What should the photos look like? And how do I compete?
Talk to me about another model, which my business partner spends a fair amount of time in, that I buy my multifamily with, student housing.
Yeah.
Do you guys have a lot of student housing type properties on your platform, or are they usually doing that outside of your platform? How do you compete with them? Like, how does that work?
Yeah, it's primarily location driven. So what you're talking about is I have assets that are close to a higher education institution, and I'll expand it to where our guys are doing it. Find trade schools. Trade schools is a massive unlock because 2 values that we give trade schools. Most trade schools are a weird duration, 7 months till you get your certification as a welder. That person's coming out of school getting paid $100,000, right? But they're federally subsidized for housing because they're looking for housing to get through school. Most of the people that are quote unquote chasing student housing have been doing it for historical years, and they're geographically close to a higher education. Our hosts are killing. I don't chase the student because they come and go. I chase the employees of the university that make less than $70,000. So the people that are engineers, the folks that are mowing the lawn, the people that work in support roles, they're there forever, but they're an hour and a half away from the school because they got priced out of the zip code that's close to that school. They're finding a lot of success with long-term tenure for people who are full-time employed at that school. Same thing goes for hospitals. So my midterm conversions I used to have traveling nurses on Furnish Finder. Well, your $6,000 COVID premium is now $2,600. Well, you unplug from that revenue stream of traveling nurses and you plug back into our model, and now you're housing orderlies, the same people that work in the hospital in a support role. They're fully occupied and they stay 1.5 years, 2 years. So there's the idea of student housing, the idea of hospitals. We just chase a different demographic that is designed for more long-term. Like, I love the term, our product it's essential housing made for essential workers. So think about all the job creators that we're seeing over the last year, large warehouses. So distribution centers, like, it's really hard to find 1.7 million square feet to build a distribution center. So it's usually on the outskirts of somewhere. And the problem is, you as a multifamily developer, it's going to take you 2.5 years to build that thing. My individual investors will look at that as an opportunity and start scooping up SFRs that are underperforming, and they convert them to PadSplit's. And now they're housing the construction workers while they're building this stupid thing. And then once it goes live, they're housing the employees that work there that want to be closer to work. So it's a fun way to use our asset and plug it into other people's business models as a value add.
So the next question I had for you is kind of the path you were going here. I'm sure you're looking at data all over the place. You're seeing people win. Where is the most interesting location, most interesting strategy, or call it something that's the most exciting that you've seen recently? Yeah.
Wow. I have seen so many different entrepreneurs figure out how to use our product. My favorite so far is a Golden Girls product where it's 55 and older, because it's not something that there's a big gap in opportunity, because if I wanted to go in assisted living, it's like $3,800 for fully independent, all the way up to $8,000 for need, right? And they sell their model based on scarcity. Oh, you better sign up now. There's only one room left. Well, there's a lot of able-bodied people that own physical houses that if they want to sell their two floors, they come into our product because it's zero entry and it's designed for that purpose for 5 years before they have to go spend $3,800 to $4,000 a month. That's a really fun one that I've seen. The other one is I love trade schools. I love the folks because they're not in A-class neighborhoods, right? We have one in Jacksonville that we work with. It's Tulsa Welding School. It's an HVAC and welding school. We house students for 7 months, their 7-month training, but then they end up staying after they get employed. They have like a 98% placement rate for their employees or their trainees. Well, that person's figured out, wait a minute, why would I pay $2,000 if I can just pay $900? So they'll continue to stay as a fully employed person. Love that. And then international students is another one that's a big favorite of mine. So to your point are you chasing higher education? We work with individual institutions just for awareness. Like, hey, your students are looking for housing. And I love international students because I chase communities, because it's easier to have people be sticky if they have a shared common community. So we cook the same food. We listen to the same music. We speak the same language. 6 of those people would rather stay in the same house for a 12-month lease, and stay for the entire year, much rather than being 12 one-off apartments that they're paying 2x for. So those are 3 of the most fun ones that I've seen. But the biggest long-term work is the long-term thing that works is have a good enough product and a good enough experience where your 2 people in your house are referring the other 3 because they all work together, right? We used to have to like suffer through, hey, people are embarrassed of living in shared housing. And now in today's world, they're leaning into, dude, I'm renting smarter than you. How much you save in a month? Right. And then people are actually talking about it on TikTok, and they're talking about it like, did you save $600 a month on housing? I did. So that rent smarter mentality is really starting to take root, and that's fun for us.
Very cool. Very cool. I was going to ask cost associated with the platform.
Yeah. So we have, there's no free lunch, start there. Our operating model is set up for initial houses. We take 8% of gross collected revenue. So we are aligned with the investor. For the initial booking fee, we keep the first 10 days of collected rent. So we call it 8 and 10, unless you actually fill your own room. So for us, it's how do we speed up the return on our cost of acquisition for the member. 2 reasons we do this, and I want to make sure that I'm really clear about this. We don't want bums. And I'm not talking about the members. I'm talking about the hosts, right? If you put out a crappy product where somebody moves in and be like, oh, this is gross, I want to transfer out. Like 60% of those people don't book another room. I don't want poor operators because it costs me money as a platform. It costs everybody money who's on our platform. So to elevate that lowest bottom feeder, the 8 and 10 is incentivized to improve the member experience. So member books, average tenure is 9 months. We want them to stay as long as possible. And the 2 major caveats to that are, what's your room look like? And what is the move-in experience that the member experiences? Meaning that I go to unlock the door and the door code doesn't lock, but I work a second shift at Amazon, 11:30 at night, it's raining. I can't get in the damn door, right? So it's like, how do you mitigate those type of really bad experiences? So it's 8% collected of gross revenue collected plus the first 10 days of every move-in. So essentially your first 30 days, 1/3 of your initial rent is captured by the platform. And again, it's not day trading. And this is where people who want to complain about it, I'm like, at 8%, we used to be 12. At 8% for a good operator, you're killing me, at month 6.
And that's assuming you're doing the management, correct?
No,
Okay.
assuming you're self-managing, right?
Yes. Okay. You're
Yep.
self-managing. Okay.
Yep.
Got
So
it.
most people, and this is the suggestion for most, is that you hire a third-party property manager,
Mhm.
and those pricing range everywhere from 6% to a flat fee to 8%. So essentially, the juice is worth the squeeze if your days to fill are light and your tenure is long.
Yeah.
So, and people ask, they're like, well, that seems really high. And I'm like, we have 15,000 doors and it's working, And the thing that I get mad about is this. If you were to buy an operating business and you did not have working capital allocated to get through your first 30 days, you're an idiot.
Yeah. Yeah.
So it's like people would forget that, like, you're not just buying a house and hoping to God that it just spits out money. It's not an ATM machine. It's a business. So treat it as such, right?
I tell people that who call me as a real estate broker all the time. They call me, they want to get into this thing. And so I ask them, a number of questions, and the final, or the point is you're either getting in this to run a business or you're not. If you're not in that mentality, then what are we doing here? Like, why are we doing this? So yeah, to your point, that's an important idea to understand.
Yeah. And the thing about it, which is beautiful, is the ones who get it, they squeeze more juice out of it, right? Because then it becomes a competitive marketplace. Like, people are transferring into certain, managed houses. So our members are starting to ask the question, who manages the house? Because they understand the management of the house dictates the member experience, right?
Yep.
They're like, hey, I want to transfer, but tell me who manages the house. Oh, Larry manages the house. Sweet. I had a great experience at a Larry managed house before, right? So I'm willing to pay a $25 premium to move into one of his houses because I know that they're going to respond and I'm going to have a better experience. And then that's how we're seeing, like, people branding out their products. They're seeing like they're running businesses on top of our platform. It's like Airbnb. I go to Sonder, I know what I'm going to get, right? Because they branded it as such. If I go to this place over here, it's kind of sketch, right?
Mark.
And the only thing I can tell you is like, hey, here's the member experience and this is my member feedback. So those tools we have in place where the members can start seeing, all right, what's the feedback on the house? Maybe I'll just swipe past this one and move on to the next house.
Very cool. There's systems in place in the Airbnb world where they'll help you even select the property itself, and they'll charge a fee, obviously, to do that. And then even have the contractor ready to go in a specific market to like help you get up and running. I mean, they'll set it up top to bottom. You'll spend real money, but they almost, I'll say, guarantee a return, but they give you, a sophisticated projection, and they have expertise in that. Do you guys do any of that type of stuff?
We do. We very much do.
Cool.
So everything that Airbnb has done, we've mirrored in very similar ways, because property acquisition and conversion, that's no different. My exit just happens to be a little bit different, but the same GCs that are highly referred, the same, even to the point of the lenders. Like, some lenders look at our model and they vomit. They're like, what? 7 bedrooms? It's like looking at a platypus. Like, what is that? But the other ones that get it, they're like, wait a minute, this is a new line of revenue for me. So they have custom fit. Insurance companies are the same. They have custom fit products that meet our host's need. So GCs that understand what the minimum requirements are for the conversion, they'll be the ones that tell you, no, that's not a good house. The AC duct doesn't work. You're sitting on a 1.5 ton unit. Like, there's a lot of CapEx that we need to do. Or this is my fear, some don't say no. those are the ones that I want to line up and punch in the head, like, because what they do is they date our hosts. They don't marry them. They don't realize that, my God, this guy's going to have 5 of these houses, then I'm going to have 5 projects over the course of a year. So they try to take advantage of investors coming inbound. And so we try to eliminate those as soon as we surface them. Realtors are the same. Realtors who chase commissions, I hate them, because they don't realize that the realtor who establishes a relationship are the ones that these guys are going to buy houses for the next 3 years, because the same lesson they had in Airbnb, they kept selling to the same investor. Our investors, once they figure out how to do our business model, they want, I use this quote all the time, they just want a Honda Accord. Give me a 7.3, 7.4 that I can replicate over and over again. And I can predict what my income's going to be, because they just want somebody that says, help me look around the corner and tell me what I can expect and minimize the risk. So the investors that are building portfolios are like, find me a 4.3, 2,200 square feet, not on a septic with good parking. And they're like, give me 10 of those. I want one every single quarter.
We're going to use the same lights, the same paint, the same this, the same that. We're going to do the same.
Why? Why, Larry? Why do they not understand that all of these things that people have done before, it applies here?
Yeah.
They come into our little swimming pool and they're like, we can do it different. Why? Use the lessons that these guys who have 5 million doors have told you, right? Take a picture of your stupid paint. Because if somebody punches a hole in the wall, or they back into it with a piece of furniture, you're going to fix the drywall. You're going to put the same paint up. It's crazy sauce.
Yep. My fiance is a high-end interior designer and general contractor. And obviously, Jerron and I, we buy lower income workforce housing, multifamily. On the investment side, on the day job, sure, I sell high-end property, but as a realtor, but she doesn't usually work on my lower income projects, as Jerron knows, and she can't process the fact that we aren't designing or choosing specific paint colors based on countertops, based on this, or she just can't process it. It's a constant battle. If she looks at our new listings that go up for rental, she's like, gross.
Right, but then we have investors that'll take that same concept and go 2 rungs down on cost pricing, meaning, like, here's an example. The P&L guy will say, hey, I can buy a bed frame for $79 at Walmart. That thing's going to break in 6 weeks.
Yep.
Right. Or the nightstand that comes in with an IKEA list of, assembly things. Like I own a PadSplit. I hate Allen wrenches. I have realized the value of my time to outsource a last mile provider who's going to build me the furniture, order the furniture, and get the damn thing staged.
Yep.
Because I thought, hey, let me save a couple bucks. Oh my God. It's like 2.5 hours for every box that I opened. And I'm like, what am I doing?
Yeah.
Right. And unfortunately, the ones that don't want to heed the warning, they have to go through the sandpaper gauntlet themselves until they get, enough pain that they realize where they can allocate. But to your point, if I'm going to build a portfolio of these, it's the same manager. I want him to understand, hey, these are the locks I choose in every house. Why? Because when I go tell you to turn the room, I don't want you to tell me you can't get into the room.
Right.
That's crazy. Right. So that mentality of like, hey, systematize what we're doing, because if you're buying one of these, I suggest you don't. If you want to get into it where you can build a portfolio, toe dip with the one, learn the process and the systems, ask for our best practices, implement them, and build a portfolio, you're going to kill it. The path to get to $100,000 of gross revenue is so much faster with us, because the people who are doing long-term rentals, it's a lot of doors you have to take down. Right. And then if you're uncomfortable taking down multifamilies, it's just a different animal to go buy multifamilies. But in our world, you're generating $30,000 of gross revenue really quickly, because every room at $800 a pop times 7 rooms, 8 rooms, it's $5,000 a month, right? So you have a $60,000 to $70,000 gross revenue product, and you can get there really fast to $100,000 in top line rent. It's just that's the beauty of it. If you figure out, what it is, and then how do I back into it really quickly, realtors like yourself, I'll give you a fun little tidbit. Find the house. Realtors like, give me your investors. And I'm like, find the house.
Right.
Learn how to find the house. The money will come, because my guys are dying for good doors. As soon as you raise your hand and say, oh, I've got a property that makes sense. Do you have an investor? I'll give you 10. And they'll fumble over themselves to try to take it down. It's the ones that are like, hey, I have your investor and he just bought a house, $300,000 on market. I'm like, oh, sweet Jesus. He bought it on market. Then he's got to put $30,000 in revenue and CapEx into it. And then he comes back pissed off because he needs 6 out of 7 bedrooms to break even. And I'm like, go back to your realtor and punch him in the head. That guy, he screwed you, right? And they get mad at us because they're like, well, I'm not getting the net revenue that I wanted. You promised me 2x. I promised you 2x if you buy it right? I can't unscrew you because you messed up the acquisition so bad.
Sure.
So it's either we're going to dispo the house and start over at a loss, or we're going to add 2, 3, and 4 and have a blended rate into your total aggregated returns, and then you're back on track.
Yep.
So can I ask you guys a question? Of the strategies that are currently out there, Airbnb, short-term rentals, mid-term rentals for like traveling professionals, and ours, when you talk to your investors, what is the benefit of ours versus the other two from a top line, like just easy top line conversation?
All right. So I would just say in South Florida, and Jerron, feel free to comment on this too, but in South Florida, it's hard to buy multifamily that actually cash flows, period. Okay. So that's like not really a thing to buy something that actually makes money, frankly, in my opinion, if you actually underwrite it. And so to buy something correctly, right, is really hard in the multifamily space. There's a lot of demand for it. So that's the hurdle there. I just think this is interesting because, like Airbnb, it gives you the opportunity to have higher gross revenues.
Mm-hmm.
And so Airbnb is interesting, or a little bit more interesting because of that, but they have their own struggles and issues and hurdles. Just to take an asset and turn it into an Airbnb. Certain cities have limitations, certain, like Boca Raton, you can't do it in. Like, if you can kind of do it in, if you get caught, they're going to shut you down type stuff. So I think the just higher gross revenue is the most interesting piece of the puzzle for us in South Florida. Yeah. I think the challenge is, the one thing I think of, like when we talk about this is, and we always talk about this in multifamily, like one of the main things or the easiest things we do when we're looking at an asset, when it comes over, you check location, right? Okay. Then you're looking at the asset quality from pictures and from a Google Drive, and then you're counting how many parking spots there are, right? And so the parking space thing, I think in some of these areas in South Florida could be challenging. Mm-hmm. Immediately I was thinking, well, you could add 2 driveways to a house, right? You could probably permit that and get that done with most cities, I would think. So you have 2 driveways, maybe you could park 2 cars next to each other. So that's 4 total cars. Maybe they could park a couple on the street. Mm-hmm. There's challenges there. So if you have 8 rooms, I mean, you need 8 vehicles in theory, unless you have people driving scooters and stuff, which is a thing here in South Florida, depending on your location. Mm-hmm. So I think that's interesting. That's the challenge. That's the most interesting factor. I think the management piece is historically been the challenge that we've discussed whenever I've looked at taking over or buying bigger multifamily assets or single family homes that are renting by room. It's always been this thing of, hey, you got 8 tenants now, right? You don't have 1 tenant. Mm-hmm. So that's been, I think, a fear from most buyers' perspective. But I would say and then obviously finding ways to fill those units or those bedrooms is a challenge. So I think you guys are covering or like hitting like a few of those hard to solve spots or points, which is you're background checking them. There's a platform, there's a review process. You're collecting the money digitally, which is another thing from a management perspective that's super annoying. Like the one that I was telling you about that had 8 tenants in there. Yeah, he was making $8,000 or more a month on that, but he had to go there and physically collect cash from each one of those tenants. Tenant quality is always a thing. Again, you're trying to solve that and probably doing a better job at it than the average mom and pop that's doing this, for sure. So I think you eliminate some of those issues there. So I think it's an interesting model. I think to your point, and just like any deal or any real estate investment, you got to find the correct investment to do. And I'd just say broadly in South Florida, probably generally in the marketplace overall, it feels harder to do here than most places. And recently I've been traveling around the state trying to find our next location to spend some time in. We've spent time in Jacksonville, Ocala, Tampa. We checked out the Panhandle a bit. And so everything just feels expensive though in the multifamily space for that's marketed at least. So I guess that's some feedback for you.
Yeah,
Jerron,
that's great.
You have commentary on that?
Yeah, just to highlight, I really think the location of the property and the type of property defines the best use for the property, and that's why you have to go seek those out and find those, because you can't fit sort of, a round circle into a square peg, or vice versa, square peg into a round hole. We have so many associations here in South Florida that takes off a good percentage of the properties. You have so many of the properties that are have tight lot lines, and again, the driveways are kind of tight, so it makes it a challenge. But there are certain areas that this might work very well for. For example, like Larry, I'm just thinking like Loxahatchee would be great. You have a home out there, you've got big acreage, maybe rural Palm Beach. Maybe those aren't super close to work areas per se, but again, if you have reasonable room rates, people might be willing to travel and do that 20-30 minute commute. People are doing it anyways. I mean, people live out there and they own homes out there, so I don't see why someone who wants to rent a room wouldn't do the 20-minute commute into West Palm Beach or whatever it is. So I do think that there are areas where this type of rental, kind of short to medium term rental, really works well. You just got to find that good location, like you said, kind of check all those boxes so you don't end up in a bad situation, and buy it right.
Where we're based in like Boca Raton, as an example, especially East Boca Raton, I'd say Boca's probably very, very hard to do this in.
Oh, acquisition makes it limited. Yeah. Absolutely.
Yeah. So they like just from like Jerron was saying, small lot lines. The city of Boca is very, very intense. Like if you have
they are
cars, you're gonna get it. Yeah, you're gonna hear about it. So you just have to figure out the right location.
And the other part for Florida, and I know you guys are primarily Florida based, like insurance is real. That is a real problem. When I look at P&Ls that people are projecting, the amount of free net operating income that is chewed up by your insurance premium, it's almost 3x what the average Sunbelt buyer in a dry city would look like. Houston suffers from the same thing that you do. So if you're not getting enough appreciation for the asset that you're acquiring, where it offsets what you're looking for, that's something that people forget. Is they look at top line gross revenue, because Florida rents are relatively high. I'm like, but the trickle down to your net operating take home is so much lower than it would be in an Atlanta or a Dallas, because it's chewed up by a line item that is apples compared to oranges in every other market. So one thing that Jerron, you said that I wanted to clarify. We thought when we first started with Atlanta, you have to be in a metro. You have to be close to public transportation. Our 6,200 doors in Atlanta has expanded into a 60-mile radius outside of Atlanta, because the same fundamental values that I would have as a family owner or young professional, I don't want to be in the city. It's really loud and I don't like the neighborhood. I can go live for $1,000, full, all utilities included, and in a suburb. So maybe it's 25 miles away, and I live with 4 or 5 other people, but I'm getting that experience. One member I spoke to, I was like, why did you leave a house that you paid $160 for and now you pay $240? She's like, the neighborhood that I moved to, the job is the same, but I get paid $10 more an hour. And at night I can go for walks, and I just feel safer. I'm like, okay, that is the value prop. That is you using my platform for your own specific benefits. And she's like, because I stayed here for so long, I now have a car that I lease. So it freed her up to do all, and it was like the greatest conversation ever, because I'm like, you get it. It's not just me as the landlord taking it, getting the benefit of it. It's you as the renter figuring out how to get more value out of it. So those are really fun things.
And it's fun to see those renters that are kind of moving up a ladder, through your through PadSplit, through
very much so.
Through your platform. They're able to make more money, move closer to better work, or just to have a better lifestyle, live in suburbia and live that suburban life that maybe they wouldn't do otherwise. Maybe they'd be trapped in that urban bubble that they just don't want to be in anymore. So it's great.
Absolutely.
That you
Larry,
all are
you said something that jumped out to me, is that, what we're seeing a lot more of is folks that were high net worth individuals that got burned on their first syndicate. So the multifamily syndications that they had put $200,000 into, or $300,000 expecting a set return, and now they're getting capital calls on those investments.
Interesting.
Those same high net worth individual physicians or lawyers or not, whatever the case may be, once they find our product, they're redeploying the same capital, their next syndicate dollars, they're redeploying into our model and building a portfolio of quote unquote multifamily through single family acquisition. And those are the ones that get the financing piece. They are the ones that understand, wait a minute, I have 30-year debt. I'm going to burr out of this. My same 300,000 comes back to me. And then I redeploy. So now at the end of 3 properties, I have 21 doors, which is essentially a small multifamily, but I have $10,000 a property left in each deal. And I'm sitting at $270,000 liquid cash that I can redeploy again. Those are the ones that are fun to talk to, because they realize, A, I have working capital. I just needed someplace to park it. And I get it that I'm going to use a third-party property manager and I can build a portfolio. Those guys are thriving, because they would have been sitting on that same powder, waiting for interest rates to get back down under 5. Right. So now they're like, wait a minute, I should be actively doing something with this capital. And once they found our model, and typically they had a friend that brought them in, they're actively participating in acquisitions again. But this is the exit they're currently utilizing.
I love that. And you still get all the same tax advantages that those guys like from real estate, right?
Yeah.
Same thing.
Nobody loves a cost seg more than us.
Right. There you go. I'm actively looking for a cost seg right now. Jerron, I think.
Same with me.
I need a big one. So I'm hunting. Nice.
That's awesome.
So are you, and the last question I have for you, you've been very generous with your time here, which we appreciate, Quentin, but so you are seeing actual syndicators creating funds to buy single family residential and create the multi-family experience. Okay, that's cool.
We have a family office that raised $52 million. They're deploying it in our product because they had a year of track record, right? Yeah. I don't necessarily love the product that they're putting out. Like, they put out some high door product, but it's higher finish, so it's a 10-3, 10-4 because they wanted that return for their investment dollars. But they're putting out a really nice product, which is like full LVP flooring. It just looks like one of those, fully renovated white on white rentals, but they're doing a good job. And the operators that they're partnering with are returning a good experience, which is, for us, the most important, is that members continue to rebook in their houses because they're having good experience for the member.
That's awesome. That's great. Larry, do you have any other questions for Quentin?
No, this has been super informative, very interesting. Maybe we'll be getting into this. So.
This is awesome. I think our clients and viewers and those who run across this video will get a lot out of it too. You're really the first guest that I believe we've had on that has really touched in that sort of medium-term rental space. So this was very educational. So we appreciate it, Quentin.
This is good.
We're going to put the contact information in the video, in the description of the video. But just while we're on here, what's the best way for people to get in contact with you? Do they just go to PadSplit.com and reach out to customer service, or what's the best way to go?
So there's if you go to PadSplit.com, there's a big ribbon at the top of our page that says begin hosting or start hosting. And then there's a form to fill out. You get into our sales cadence, and then you get assigned to an account executive, and then we go from there.
Right.
There is we run a whole series of free webinars as well, intentional for education. Like this is heavy. It's not a simple lift. It's not like, going to buy a Turo, you know what I mean? It's not a car and rent it. It's a little bit longer educational piece. And our biggest hope is that we can minimize expectations and reality. Like I keep saying it to all of our sales folks, like that gap is called resentment, right? And the more we can squish it, the more we can compress it so that you get exactly what you expect. We know that 500 investors around the country, they're getting what they wanted out of it. We want you to be 501, but don't come in here with inflated, crazy expectations. Because if you're not hitting those, then you just get mad and then you're blasting me on some Facebook page, right? It's like, come into it, understanding what you're getting into, eyes wide open, and lean in and leverage this wave that we're on. Like you guys are talking to me and you're an eviction attorney, right? Like you're a realtor that like, wait a minute, what are you again? And like a lot of people love the what. I just want to spend more time in the how. Right? Like we just give free education out left and right because we want you to be good operators, because it's essentially where we win. And that's the beauty of it. So I'm grateful for you guys to give me the time here and talk to your audience, because like many of them don't even know we exist.
I agree.
Right?
I didn't know you existed.
Exactly.
Until now.
So
that's great. We're happy to spread the word.
Thank you so much.
Yeah.
Good.
Thanks again for the time.
Thank you for the great conversation.
Thank you, Quentin.
Talk to you guys soon.
Okay.
Take care.
And thank you guys for tuning in, and we'll see you on the next episode.